Watch the ticker. This level of acceleration defines the aggressive momentum we saw in mid-April as U.S. equities launched into a massive relief rally. This split-screen timeline maps the action. S&P and Nasdaq surged past January highs. On the bottom, Brent crude initially spiked past $100, but by Friday, WTI crude plummeted over 10% to $84.68. That sudden drop created a sharp rotation across the market. Oil majors like Exxon and Chevron took a heavy hit on the plunging crude prices, while airlines and travel stocks soared on the prospect of cheaper fuel. This leaves retail investors facing a difficult choice. Does this sudden rally signify a return to a safe economic landing, or is the market walking into a trap? Right now, algorithms and institutional buyers are buying on headline relief, but headline relief does not equate to structural safety for your capital. We trace Friday's market explosion to this map. Poor moves for commercial shipping. Wall Street algorithms immediately signaled the crisis was over. However, the physical reality on the water remains quite different. Look at this infographic showing the physical cargo flow. Actual shipping traffic passing through the strait is currently operating at only 23% of its normal volume. Furthermore, the U.S. blockade remains fully active. Ships are not moving freely. Investors chasing this current rally are pricing in a complete resolution based on a situation that is mathematically only 23% resolved. This creates a massive vulnerability for anyone holding a momentum-heavy portfolio. The current market optimism relies on a simple assumption. Oil is back down to $84, therefore inflation is beaten and profit margins are safe. But physical supply chains don't operate on daily spot prices. They operate on cost lag, much like these freight trucks carrying goods ordered weeks or months ago. Before Friday's sudden drop, the global economy spent weeks absorbing sustained energy costs well over $100 a barrel. This chart projects upcoming second quarter corporate earnings. Notice this shaded block eating into the profit margins. That is the inflationary penalty from those weeks of peak energy costs, and it is already baked into the upcoming reports. We saw the 10-year Treasury yield drop to 4.24% on Friday. That tells us inflation fears are easing in the moment, but the bond market's current relief does not erase the historical data of the past month. By ignoring the delayed impact of that expensive oil, Wall Street is blinding itself to the risk of sudden stagflation shocks when those actual earnings are finally reported. So who is buying right now? Primarily momentum investors, who are pouring capital into the S&P 500 and riding the Nasdaq tech surge. The trade-off for that strategy is straightforward. You get to capture the immediate daily gains, but your capital is completely exposed to any sudden geopolitical reversals. You have zero downside protection. This table breaks down the alternative approach. Instead of chasing broad index hype, you rotate your capital into value. You look for companies with low debt and deep moats that the recent tech surge entirely ignored. A clear example of this is ADP, a business known for paying high-quality dividends. Looking at this scorecard, ADP is currently trading near a 52-week low. More importantly, it has a highly favorable price-to-earnings ratio of 19.87. Compare that steady cash flow to the speculative growth assets currently driving the indexes, which are trading heavily on market sentiment rather than underlying value. You might sacrifice the daily excitement of a tech-driven rally. But buying a profitable company at a discount offers a significantly stronger compounding opportunity over time. Benjamin Graham and Charlie Munger frequently reminded investors to be greedy when others are fearful. To apply that practically today, you hunt for value where the market is either terrified, like the plunging energy sector, or completely apathetic, like boring dividend payers. This diagram illustrates the strict rule you need before making a purchase. The solid block is the intrinsic value of the business. The line is the market price. You must demand a 25% buffer zone between the two. This 25% buffer provides the mathematical insulation needed to absorb the impact if the U.S. blockade tightens or inflation spikes unexpectedly. If a stock requires a perfect economic environment to justify its current price, it is too dangerous to hold. Maintaining that strict margin of safety is the only reliable way to separate enduring value from temporary, headline-driven momentum. This decision tree maps out exactly where your capital can go this week. If you choose this first branch and trade on momentum, understand that playing a flow-driven game without downside protection is a massive gamble. But if you take the second branch, you are focusing on compounding. Right now is the optimal time to screen for companies with low debt and high return on equity. Stop guessing based on the news cycle. Take your current watch list and test it rigorously. You can run your tickers through the 6 valuation models on our platform to generate a definitive long-run score for each asset. The final rule is simple. If the score does not confirm a 25% margin of safety, keep your cash on the sidelines. In a volatile market, capital preservation always wins.